Most of the time when talking about investing, people tend to discuss public markets. But there is another very large area of investment. And this is one that people tend to be curious about and generally know less about it. And that is private market investing. So I'm going to give an explanation about private equity and venture capital, what goes on in them, and how they work. So the first thing to note is that unlike going into the market and buying a stock, people tend to invest in private equity through private equity funds, which have a much more complex structure. In a private equity fund, an investor is a limited partner, and there are a number of limited partners who all invest in a fund. The general partner in the fund is the investment company that is doing the investment, and the general partner and the manager may be set up as separate legal entities, but ultimately they are the investment company. So once a fund has been established, the manager, which is a legal entity owned by the investment company, goes and takes all of the money committed by limited partners to invest into private companies. These companies are termed portfolio companies since they make up the portfolio of the private equity fund. The fund then attempts to profit from their investments. Fees for management are paid to the manager company, and carried interest, which is a certain bit of return, gets paid to the general partner. Carried interest can be thought of as a certain chunk of return that the general partner gets that limited partners don't, or as something like an incentive fee. Then the returns are paid to limited partners, and the fund dissolves. The private equity company remains, but the private equity fund does not. And you'll tend to see a difference in their names, where the investment company could be something like Market Co. Advisors, and the fund would be something like Market Co. 14 LP. It's also common to see a year in the fund's name. It'd be something like Market Co. 2020 LP, named for the vintage year, or the year that the fund began. Private equity and venture capital include a lot of different types of strategies. Saying something is a private equity fund doesn't fully explain what it is trying to do. All that says is that it's investing in private companies. So I'm going to look at some different types of funds and investors. The form of private investing that is the earliest into a company is angel investing. Very often the investors doing angel investing won't have a fund behind them. It's very common to see just an individual being the angel investor into a startup. This is very early on in the life of a company. And this could even be investing in people who have the idea for a company and haven't actually started it yet. So for that reason, usually there are very small amounts of money in an angel investment. The next round of capital raising from investors is seed round. And these are very early on in startups. Generally, a seed round is the first round in which there's actual external capital raising. That's something like a venture capital fund would be a part of. Seed stage investing also tends to happen with smaller amounts of money. After that, there are a series of venture capital investment stages that happen, and these get lettered. First are A rounds, next are B rounds, then C rounds. Typically, in these early stage investment rounds, venture capital investors will invest a certain amount, and then will be willing to invest more if the company is able to reach a certain level of growth and performance. If then that next level has been met, then a B round with even more money will be invested. If the company keeps growing, then a C round, each stage contingent on the performance of the company being invested in, with capital invested generally getting larger and larger each time. Growth private equity investing generally means investing into companies that are expected to grow more or less in a steady way. These are generally not the super high risk investments and are companies that seem stable but have much more room for growth. This could be something like buying a private company that's doing very well in its area, but the private equity investor expects that it could do very well in other regions as well. So with the capital from the private equity investor, that company will grow and expand, enter new markets, and attempt to grow the value of its equity. Maybe one day becoming a public company. Buyout investing, or leveraged buyout, is when a private equity investor buys out a whole company with the goal of changing it in pretty radical ways sometimes. This could be complete reorganization of the whole company. Very often this means taking a company that has potential but is not doing well and buying out the company, potentially taking on large amounts of debt to get it done, then substantially changing the company so it can become profitable again. A primary investment is when capital is raised from limited partners and invested directly into the portfolio company. This is an initial investment from the private equity company at the time that capital is being raised. There's also a secondary market, where shares in private companies can be sold to other funds, other investors. And investing this way is secondary investing. It's not investing using money raised from LPs for an initial investment. It is instead buying a share in a company that has already been invested in by private equity. It's more like investing in a stock that's traded on a secondary market, like the New York Stock Exchange or NASDAQ, except with private companies. A new investor, not the original investor, invests into the company, making them a secondary investor. Then the last concept I want to cover is co-investing. Co-investing is when an investor takes a minority position in a portfolio company that is invested in by a private equity manager. So say a private equity fund raises capital and buys company A. If some other investor were to come along and buy, say, 10% in that company, then that investor would be co-investing with that private equity fund. So how does a fund work? Well, investment company sets up a fund. It's a legal entity structured as a limited partnership. But it needs money, so it goes to investors and tries to get them to become limited partners in the fund. Up front, the investors will commit a certain amount of money. Now, this doesn't mean the investors give all their money to the fund immediately. Say committed capital is $10 million. They might initially only give $1 million, and then over the course of the next couple years, they pay in that remaining $9 million as the fund needs it. When the fund requests that committed capital be paid, that is a capital call. Great, so now the fund has committed capital, it has limited partners investing in it, and it has some money it can start deploying. The fund manager will seek out companies and begin making investments into them. And the fund builds a portfolio of companies, its portfolio companies. From there, with its capital, experience, insights, it will try to grow those companies. Then, over the life of the fund, it will call more capital from its investors, try to grow the companies, call more capital, grow the companies, and will begin to start giving some of the profits back to the investors. And eventually the fund will reach the end of its life. Typically, this is about 10 years, and the fund has to exit its investments. So how does a fund actually end? Well, it has to get rid of those companies, since it can't keep existing to hold on to them. So this gets us to the idea of exits. And exits are the different ways that a private fund can leave an investment. One way could be by selling the companies to other investors. This could be something like a venture capital fund, having grown a company significantly, selling it to a large private equity company. Another way could be selling it on secondary markets. This is generally not, however, how a fund would like to exit a company, as very often selling on secondary markets has seen very large discounts. Another way could be management buyout. The management of the company purchases the ownership from the investors. Now, generally the best one that everyone hopes for is IPOing, taking that private company and selling its shares on the public markets. And generally a more unfortunate one is liquidation, where there's no one who's really going to buy the company, at least not at a great price, so its assets are sold off and the company is dissolved. After the investments are exited, the investors get the last of their money out, and the fund dissolves, hopefully making the investors a lot more money and putting the companies in a much better position. So I hope this general overview was helpful. There is a lot that goes into private market investing, and it can get pretty complex. But knowing what's out there and how it works can really help a lot. So I hope you enjoyed this overview, and do subscribe if you're interested in seeing more of these financial videos. And until the next one, have a chill day.